Hi, everyone, and welcome to our Module 6, where we're going to talk about choosing and protecting innovation/technology projects. You can imagine, and you've probably seen that in your career experience, thinking about which projects to pursue, whether those are technology or innovation projects, whether that's other types of projects that you have encountered, is always a big debate, right? So what are the kind of criteria you want to use to actually make these decisions? We're going to talk about a few tools here. You've definitely seen plenty of them in your experience in one form or another, so you might recognize some of this. If not, that's perfectly fine. And then in the second section of this module, we're going to talk about protecting innovation, namely patents, trademarks, copyrights, et cetera, et cetera. So we have, as you can imagine, different types of methods to make these decisions. Some are highly structured, some are more informal. You decide with your friends where you want to go for dinner or lunch. That's typically, hopefully, I assume, an informal process where people make some suggestions and then you kind of weigh some criteria and then you decide to get to the place. When we think about innovation projects, technology projects, we typically, because there is a lot of money involved and resources that we have to commit, right? We have to have more structured or more rigorous methods to justify these kind of expenses. Typically, and that is kind of the biggest kind of macro level, big picture way to think about resource commitment to innovation and technology is the development project, a development budget, okay? And typically it's measured by R&D, right? The R&D budget, and that's measured as a percentage of previous year's sales, right? That's kind of a typical metric. Now, what you do, right? So this is a pretty macro level metric, right? So you can imagine that firms that spend a lot more money on R&D also have additional methods of how to determine the success and the viability and the trajectory of technology and innovation projects. Most of which, these techniques are mostly related to kind of trying to predict something in the future based on some historical experience. These R&D ratios, right? They can vary significantly by industry. You can imagine that industries, software industry, for example, typically has a higher R&D budget than if you're working if you're in Walmart, right, or your grocery store. You typically don't spend that much money on R&D, although Walmart did have a fair amount of technology and innovation initiatives. But yeah, typically high R&D budgets are reserved for companies that are focusing on technological innovation. And here are some examples: medical equipment, semiconductors, software, drugs, right, biological products. So if we think about the biotechnology industry, a lot of money goes into R&D, right? They're essentially the research arms of these companies are dominating the budgetary needs of the overall company. Example 2013, and we'll see that has switched a little bit since then. And you can also think about the fact that most of the car manufacturers here, right? So R&D intensity. So this is ranked essentially by total amount of money, and in this case it's $1 million, but this is billions essentially, right? So 5 billion here, 14 billion here. The idea is essentially, again, different industries have different needs at different times. Certainly, 2013, 14, 15, 16, right? We talked about electric vehicles a lot. We've seen that car manufacturers started to invest in electric mobility. And these investments were escalated over time, right? So in the last 10 years, we've seen a massive escalation as Tesla become very successful with their electric propulsion and powertrain systems. Other big car companies had to kind of imitate or copy these efforts, and therefore have to spend more money. Now, if you look at Google, for example, okay, so Google spends about $8 billion. That's 13% of their overall sales. Merck, which is a drug producing company, they spent about 17%, quite a bit, right? Intel, about 20%. Again, these are 2013 numbers. When we go to 2017, we see that there's been a little bit of a shift, right? So 4 years from 2013, the market capitalization, revenues, and profits of these tech companies kind of grew significantly, still growing. We're currently now in a little bit of a burst tech bubble, but don't be fooled, these companies will still dominate future revenues, future investments, and R&D projects. That's kind of the platforms they build are so successful that we'll have to see how exactly who would ever dethrone them and how the overall industry and market kind of will develop in that arena. Yeah, so Microsoft, you see, Samsung, Alphabet, Amazon, tech companies have been quite dominant in terms of how much money they spend on development. Here is an example for 2020 pharma industries. I don't know if you're familiar with Insight or Regeneron Pharmaceuticals. Most of these are biotechnology companies. And look, so Merck, for example, had a $13.5 billion R&D budget. That's about 28% of their revenue or their sales. And you see other companies that spent about, specifically Insight, spent about 83% of their sales is put into their R&D budget, right? And so these are kind of some macro level considerations to think about whenever you want to look at a company that is churning out a lot of, technological, but innovation in general. The R&D budgets are definitely a good metric there. So we talked a little bit about core competencies and core rigidities, right? And some of the things that we encounter is that big companies typically have a lot of resources that they can spend on R&D or innovation projects, right? They have to be very strategic, right? They are typically very formalized, but the idea is because they have this revenue growth and this profit growth, they're using these resources and putting those back into the company to drive future innovation projects. Now, you can imagine, most of the innovation projects or most of the technological innovation projects in companies are funded internally, right? So because they have this kind of surplus of financial resources, for startups, that's not the case, right? And so you talked about, I don't know who of you is doing the QuantumScape final project, but you see in that is an example where you have a startup that grows over time that essentially has to finance their innovation through external investors, right? Typical venture capitalists, maybe some banks, selected banks that provide some equity, angels, right, in the early stage of entrepreneurial development. But they need external funders. And the reason they need that is because their innovation or their inventions are not generating enough revenue yet to support that, right? In fact, in many cases, they are in a pre-revenue stage. You saw also the example with the nuclear reactor, with the modular nuclear reactor. You had to spend, these guys had to spend over a decade, right? They had to collect about $1 billion to fund their R&D, right? So we've seen there's quite a dichotomy on how firms kind of finance this. In most cases, again, you most likely in your career, not that I want to discourage you to work for startups, but in most cases you will work for a big company, and big companies generate, they pay for their innovation through their own revenue and profits. Okay, so I'll talk about kind of these two methods primarily. Most of you, if not all of you, will be probably familiar with net present value. So I'll just do a quick revision here. If you're not familiar, then that should give you some quick overview. If you are, then just don't worry about it. You probably have some experience in determining that using net present value. But the idea, and we are here, I'm working for the Department of Finance and Innovation. The idea is really financial tools, right? In this case, discounted cash flow. The idea is that you can use finance tools to figure out which of these projects might be more financially viable or profitable, right? Always assuming that you have your data correct, right? Which is, and we'll talk about this in a little bit, a potential flaw in these kind of methods. Now, typically what happens is, discounted cash flow, right? The idea is that any money I want to invest in an innovation has to generate some kind of return on investment, right? And the rate of return that each project has to generate depends on the company, right? Depends on how this innovation is financed, what is kind of the return on investment that this company has promised shareholders, right? If you're very aggressive, you promise 15, 20%, or you give big dividends, means that you have to focus on high impact or financially high impact projects. And so you have to kind of develop you have to be more rigorous with your financial tools here. This is a pretty simple example. Okay, the NPV can be done. There's all kinds of really sophisticated analyses about that. I don't want to get into kind of the nuts and bolts of that, because that can get pretty complex pretty quickly. And for those of you who have taken finance classes, you're certainly aware of how complicated that can get in terms of assessing that. However, I will make sure to post some additional resources in Canvas, and so you can have the opportunity, if you want to dig a little deeper into these issues, to spend time on that. But essentially, the idea is, so I'm gonna want to invest, let's say $9,000, right? I need to borrow these $9,000 to finance this innovation project. And when I borrow money, right, even if it's internal, the company, when you're a Fortune 500 company and you go to the corporate bond markets, you typically pay a certain amount of interest when you borrow money, right? And we've seen now interest rates have been going up. But in this case, we take a simple example. Okay, so the $9,000 I'm going to borrow to finance this innovation project, I have to make at least a 10% return on investment to break even. So you kind of do your calculations, right? You know that if you develop this product or this project, it will generate a certain amount of cash flow. Again, whether these estimates are correct or not depends on the uncertainty, right? Depends on, it comes with a whole other set of assumptions and calculations, right? So that's why this is a pretty simplified case. But what happens is, right, we have to think a little bit about, my initial condition is I have to spend, need $9,000, and $9,000 I need to pay back, right? If my interest is 10%, I need to pay back that money. So I'm looking at these kind of cash flows, and the idea is really that, there's a formula for it, which is the present value equals cash flow divided by 1 plus the required rate of return, and on how many time points we're gonna do these things, right? So each of these numbers, again, and the time point, we call this time point 1. It could be after 3 months, right? It could be after 6 months. It could be after 1 year, right? These are things that you'd have to figure out in your specific project, okay? And so what we're gonna do, we're gonna calculate that. We're gonna add, so 2,000, right, is my cash flow that I expect at time point 1, times 1 plus 0.1, which was my rate of return that I need. And I have it to the 1, which is kind of the first time point. As the time points increase, you're gonna see that this part here increases as well, right? The bottom part of the equation. So my present value is $1,800 after time point 1. Then the present value here is 2,479, 2,253, etc., etc. Just put it in a calculator, and you kind of add these together. Essentially, right? The present value of 0.0 plus the present value of 0.1 plus the present value of time point 2 plus present value of time point 3 plus present value of time point 4. And are you going to launch the project or not? And it's actually quite simple, right? So the net present value in this case is you take the $9,000, you subtract it, so you add these 4 things together, and then you subtract it by how much money you borrowed. If that is positive, right, then you can decide whether you're gonna launch a product or not. If that value here is negative, then you're essentially losing money based on the interest that you'd have to pay, right? So, and obviously this value here, right, these values here will depend on what your expected return will be, right? If your expected return is 5%, then this number here would go up, right? Because you have less interest that you have to worry about. And so this the project will break even quicker, right? So as your rate of return or your needed rate of return goes down, the probability that this is positive goes up, right? And the other way around, if you need a expected return of 20%, in this case, this would be 0.2 here, then this value is going to shrink, right? It's going to get smaller. So then you have to figure out, can I increase the cash flows here, right? If I can't, right, if these cash flows are pretty accurate, then I have to really think about whether I want to launch the project or not, okay? So pretty simple. Again, you can also there's plenty of net present value videos online, but this is kind of the basic idea, right? I include my rate of return that I need, my threshold rate of return. As this rate of return goes up, I have to generate more cash flows, because if I don't generate more cash flows, I won't be able to recover my money, right? I'll make a negative, I'll generate negative interest. All right, so this is obviously connected to the idea of the internal rate of return, right? And again, where that internal rate of return is really depends on what the borrowing costs for that money is, right? For example, if you make a 10 billion, so neither Amazon, so Amazon, for example, doesn't pay any dividends, right? So the money that they generate through the company, they don't have to give money back to the shareholders. And the advantage is that they have this surplus money that they can spend on innovation and technology projects, right? Okay, so now, again, if cash flows vary, right? In this case, we assumed that cash flows didn't vary. But if cash flows vary, right, we're making an estimate of my cash flow for time 1, time 2, time 3, time 4. But if those vary, in how much, you know, the cash flow, essentially, we couldn't really calculate a fixed cash flow. If we predicted, we would have to have some kind of a cash flow range, right? So instead of saying, oh, okay, you know, this is cash flow 2000 at point 1, what we'd have is essentially a range between, let's say, $1,500 and $2,500, right? Depending on which of these scenarios are more likely. And so in this case, we're going to look at that. We're going to look at the potential for multiple IRR, right? Internal rate of returns. And that's typically done by finance people, right? Or project managers might also have to be involved in that. But if you have like a certain finance division, they will give you all these estimates, right? They will figure this out, and they will say, oh, okay, so given what you're predicting, right, your net present value or your potential profits here will be such and such, and that is meeting our threshold, or is above our threshold, or below our thresholds. Now, the strengths, I think, are pretty clear, right? It helps structure the process. It gives some clear outcomes on whether I should, which projects I should pursue. It makes projects comparable, right? So if you have to make a decision between project A, B, and C, it's a lot harder to do with people's opinions or people's subjective estimates. A lot easier to let them run through the finance, through a financial model, and see which of these have better prospects than others. Weakness of this approach, as you can imagine, is that it really depends what kind of, how accurate your financial estimates are, right? If your financial estimates are not very accurate, then you're going to have trouble calculating accurate net present values. And so if then your net present values are expected to be off by a large margin, you might kind of make the wrong decisions here. And again, at the same time, right, for companies, it is important to understand the timing of an investment as well as time value of money, right? So you can't really operate without that. And so then again, the challenge is here, making as accurate financial predictions as possible so that your net present value or your discounted cash flow methodology is accurate. Now, another one, and again, this is for finance people here, real options, right? So some of you might have, you know, bought and sold options on the stock market, and the idea is pretty much the same here. We built kind of our research portfolio, right? Or we have these our innovation and technology projects. And the question is, how do I kind of protect myself if things don't go as planned, right? So I want to think about, how do I exercise an option, right, for a project if certain criteria are met? And as with stock options, right, you typically use options, whether they're the put or call options, to secure your portfolio, right? And they are essentially act like an insurance, right? That's what I buy options for. In many cases, is I try to insure my portfolio. Now, there is a couple of examples, okay? And so, for example, you can sell or you can create options to commercialize a technology, right? Essentially, you want to license something and somebody else is saying, oh, okay, the entity who owns the license will say, hey, I'm happy to give you the licensing options, right? Or you can exercise a licensing option to certain conditions if such and such criteria are being met, right? And for example, think about patents run for a certain amount of time, right? They're not, and you typically don't have a patent protection in perpetuity. And so that way you can actually look at, use these options to hedge against kind of the time that is depreciating the value of your patent in a way. That's one possibility to do. The other possibility is, again, you could acquire a partner potentially, right? So if certain conditions are met, you buy an option, right? This partner sells you an option and saying, hey, if you buy this option and certain criteria are met, you get the right to buy a share of our company, for example, right? And again, depends on what are the cash flows, kind of the cash flows and the benefits, the capabilities of your partner, and whether you're really interested in acquiring them. But options are essentially like an insurance policy, right? Instead of acquiring something immediately, you acquire an option to acquire or to pursue something in the future, right? And that keeps your initial capital costs low. It reduces the risk if for example, your partner doesn't turn out to be as prolific or as successful or as capable as you thought. You might find out that the technology you wanted to acquire isn't as spectacular or as successful as you thought it would be. And so that keeps your costs of acquisition relatively low, right? Again, same ideas here as we talked before, right? We use these finance tools to kind of to financialize, so to speak, the innovation and technology space, and that can make sense in certain circumstances. But not all technologies and innovations behave in such a way that you can actually that you can fund and support them like it's a capital market, like you do in a capital market, right? Because you just don't always have that level of certainty and transparency that you have for companies, right? In the financial markets. And that's it's important thing, right? So the value of stock option is independent of call holders' behavior, but value of R&D investment is shaped by the firm's capabilities, complementary assets, and strategies, right? And so this is a lot less predictable in many ways than if you buy a call option on a particular company, on a particular firm, that you assess based on, you know, market development, financial statements, etc., etc. So in any way, I'm just demonstrating this. There are some tools here that are quite interesting, that, you know, kind of help us to structure this, but they're not perfect, right? Financing tools are not perfect in terms of trying to pick innovation projects. Therefore, you need to use some qualitative methods as well, right? Other quantitative methods, for example. We do a lot of customer surveys, right? You need to think about and analyze the role of your competitors or suppliers' capabilities, right? And you need to think about the project timing and cost, right? And kind of the value this project or this technology could give you in the marketplace, right? In many cases, you can't fully predict that. Same with the kind of smartphone, the idea of the smartphone, right? Should we invest in the smartphone? Should we roll it out in a big way? There have been some successes previously, right, and some failures, like the BlackBerry, for example. But ultimately, you really have to understand whether your customers, right, if you roll out a new product or new technology, whether your customers are interested and are willing to pay a premium for that product, right? And so these assumptions, this kind of research, customer research, is pretty central to make a lot of these assumptions that we talked about in the net present value and discounted cash flow methods. Now, this is kind of another way to frame certain things, right? And this is a pretty good macro framework to develop, right? So if you are a manager, right, or if you kind of a CEO, CFO, or somebody who's a chief technology officer, or somebody who's high up on the R&D management space, you want to start ranking R&D projects, right, qualitatively, which means you want to look at their resource commitment, you want to look at the level of risk, you think about the timing of the cash flows, right? When would you expect the money to come in? Would you think that it's going to come in big chunks? Will it behave like a straight line? Will it behave like kind of a parabola? And here you can also look at how derivative or new the products that you're trying to introduce are, right? So if this is an incremental innovation, then maybe your financial projections are a bit more reliable, right? It's easier to predict that because you're basing it on an existing product. If it's a completely new product, your financial projections might be off a lot more, right? So you have to put that into consideration. Same way is, are there any process changes involved with that product, right? Whether it's on your end, right? You have to change manufacturing, you have to change kind of the way your company operates, or whether it's on the customer side, right? Do they have to change a big part of their behavior if it's individual consumers, just the way they do things with the current product, right? So that's a good framework to think about. And then you have all kinds of, like, this is kind of the idea, is that similar to incremental and radical innovation here, we want to look at what type of technology innovation projects are you actually looking for, right? Is this an advanced R&D project? Is this a breakthrough project, a platform, a derivative, et cetera, right? So you have to think about that, right? You have to kind of assess that. That needs to come into the equation. And here is lastly, kind of a quick method, or a method that, you know, some companies use, called a Q-sort method. Some of you might have seen it in research as well. The idea is really, we want to rank ideas, right? Back to when we discussed creativity here. But if we think about technology projects, we could come up with, right, one of the problems we have when we do these rankings, right, is we typically take people's opinions for that, right? Because when we don't have hard financial data to go with, we need to ask managers, employees, developers, customers, et cetera. And so we need to rank these opinions or positions properly. And so Q-sort is a methodology that has been used for researchers that do qualitative research, right? They want to know, for example, what people think about the current political climate, or what people think about controversial topics, right? And so they're trying to rank, right? They're trying to look at the potential bias or subjectivity. And so the way to do that is, one possibility is what's called a Q-sort method. And in the case of our technology projects or ideas for technology projects, we can kind of develop these dimensions, right? From I like the project a lot, or I think it's very attractive, to I find the project very unattractive. We ask a bunch of people that we think are relevant, and then we keep going through those dimensions, right? So what we do is essentially we kind of keep asking people, right? We keep refining essentially our algorithm. Is often also used in a computerized version. And yeah, so it's quite interesting. If you want to know a little bit more about it, you're welcome to use that YouTube link here. There's a guy who specializes in it, and he explains that pretty well. Has some really good examples with that as well. Okay, so that concludes the first section of module 6, and I will be seeing you very soon for our second section.